Ladies and gentlemen, good day and welcome to Sterling Wilson Renewable Energy Limited Q1 FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Thomas Mathew, Head Investor Relations, for his opening remarks. Thank you, and over to you, sir.
Yeah, good morning everyone and welcome to our Q1 FY25 earnings call. Along with me I have Mr. Amit Jain, our Global CEO, Mr. Bahadur Dastoor, our CFO, and SGA, our IR advisors. We will start the call with the key operational highlights for the quarter and industry outlook by Amit, followed by financial highlights by Mr. Bahadur, post which we will open for Q&A. Thank you and over to you, Amit.
Thanks, Sandeep, and a warm welcome to all the participants on this call. I would like to begin with a quick update on our business operations and outlook for solar industries. Beginning with our order book, we have started off the first quarter of this financial year on a strong note with rupees 2,170 crores of new orders, building on the order booking momentum in FY24, where we closed the full year at approximately rupees 6,023 crores of orders inflow. Q1 order inflow was a mix of international and domestic orders. We were able to achieve a strong breakthrough in the rapidly growing South African solar market with 2 turnkey project wins totaling $140 million. First was a 140 megawatt DC project for AMIA Power, which is one of our customers with a long-standing relationship, and the second was a 80 megawatt AC project with the Energy Group. As we have reiterated in the past, we only judiciously pursue international projects which meet our risk-reward matrices, and these order wins are in keeping with the same philosophy. The pickup in international ordering activity seen in the recent quarters in select international markets like Africa and Europe is a culmination of our effort over the past few years, and we are happy to finally see it paying off. Our India EPC business continues to remain a pillar of strength, and company has received new order and LOIs in 3 domestic projects worth Indian rupees 1,016 crore during the quarter. We were able to achieve another breakthrough with Serentica Renewables by bagging a 900 megawatt DC project in Rajasthan, which is one of their largest solar installations in the country. We continue to work with Serentica and multiple other projects across India, and we are happy to be their preferred EPC of choice in this project. We have commenced a pilot project for solar plus battery energy storage systems for Reliance Industries at Jamnagar, Gujarat. We look forward to engaging with them in large PV project installation across the country in near future. With the order wins announced in Q1 setting up a strong base, we remain confident of meeting our order inflow guidance of rupees 8,000 crore that we have indicated during the previous conference call. Further, in terms of execution, we anticipate to see a strong pickup in execution from Q2 onward, and we will be targeting to achieve majority of our execution run rate in the second half of the fiscal year, with which we remain confident to deliver on the revenue guidance of 8,000 crore rupees plus as well. We have a strong order book already in place, and plans are in place to achieve the anticipated execution scale-up. Our unexecuted order book currently stands at rupees 9,396 crores with approximately 71% constituting domestic orders. While the share of domestic order has declined this quarter due to higher inflow of international orders, we remain confident of domestic order inflow in the forthcoming quarters, picking up especially as PSU order inflow activity was muted in Q1. We are, however, seeing a strong pipeline getting built with the new RFPs getting added, which leads to greater visibility on ordering activity pickup during this fiscal year. Coupled with a stronger balance sheet, we are expecting to be able to capture a larger share of the domestic solar EPC market in this fiscal. In terms of pipeline, we are actively pursuing projects totaling 23 gigawatt in India and 5 gigawatt in other geographies, including Middle East, Europe, and Africa. I know most of you are anxious to hear about the progress with the Nigeria project. Our teams are continuing to engage at the highest levels to achieve the closure, and while post our last investor call, the final terms have been negotiated, procedural steps are in progress. Also, as I have mentioned in our earlier calls, post-order signing, we expect project to take 6 months to achieve financial closure. We would like to reiterate that lumpiness in order inflow is to be expected with EPC companies like ours, and the timelines for achieving project closure could vary depending on a host of factors, including finalization of contractual terms, financial closures, etc. Our operation and maintenance portfolio outlook remaining strong, and we have seen our portfolio grow to 8.2 gigawatt as of June 2024. The benefit of a large portfolio is expected to bear fruit in the coming quarters as our EPC pipeline will continue to feed a large portfolio of O&M projects over the next 12 to 18 months. Now moving to industry outlook. India remains our single largest focus market at the moment. The government's renewable energy push is driving up auctions, which continues to create a strong pipeline. India saw auction of 35 gigawatt of renewable projects in fiscal 2024, the highest ever in a single fiscal year, and the solar remains at the forefront. The demand for power is expected to continue to increase annually by 7 to 8% over the next 3 to 5 years. For renewable power to provide for this increase, the annual capacity addition become imperative. There is no doubt in our minds that renewable energy going to be a key driver of investment in the power sector in India for the next 6 to 7 years. The growth of renewable energy installations is anticipated to accelerate as the tendering and commissioning of green energy projects gain momentum. A growing domestic order pipeline is reflective of the explosive market growth that is anticipated. Such rapid growth typically pushes players to focus more on core competencies and execution that their established EPC players like ourselves is likely to gain. Low module prices globally remains ripe for the more projects to come on stream, aided by lower LCOEs, which should translate into more work for EPC players like us. With a strong balance sheet, we remain well positioned to tap the strong industry growth in both domestic and international markets. With this, I will ask Bahadur to take you through the consolidated financial highlights. Thank you very much.
Thank you, Amit. We are happy to report a second consecutive quarter of positive EBITDA, PBT, and PAT at a consolidated level in Q1 FY25. We achieved a top-line growth of 78% year-on-year with operating revenue of 915 crore in Q1 FY25, aided by higher execution in domestic EPC projects. Sequentially, top line declined by 22% due to tight liquidity conditions, which are expected to ease with improvement in credit ratings going forward. At this point, I would like to mention that Q4 is always the highest in a financial year due to push from vendors, contractors, and developers. So it would be incorrect to look for sequential growth in a Q1 as compared to a previous year's Q4. As Amit highlighted earlier, our order book continues to grow rapidly, providing higher revenue run rate visibility for the forthcoming quarter. With anticipated ease of liquidity challenges, we still hope to be able to meet our annual revenue guidance, which implies a lot of execution pace pickup, which will be seen in the second half of this fiscal. On the margins front, our reported gross margin was 11% in Q1. We believe our gross margin will hover in the 10% range as seen in the domestic EPC margins for the quarter. Our O&M gross margins were enhanced due to one-off income of 3 crores due to backdated revenue receipts and provision reversals. It is worth noting that in few of the previous quarters, we had taken a conservative stance on accounting for the O&M costs, but not revenue, and had guided that we will be able to bill backdated revenue, which was seen in this quarter. Recurring O&M margin was 23% in the first quarter and has begun to trend towards more steady-state margins compared to FY24 margin of 16.7%. On the overhead front, we have continued to make further progress as seen in the lower quarterly run rate. We do believe bulk of the optimizations we had planned have been incorporated. Reported Q1 EBITDA was 37 crores at a 4% EBITDA margin compared to a full year FY24 EBITDA of 54 crores. Reported Q1 PAT of 5 crores, while significantly higher both year-on-year as well as quarter-on-quarter, remains impacted by a non-cash deferred tax asset charge in this quarter of approximately 10 crores, as was the case in Q4 due to standalone profitability. Now coming to the balance sheet, our net borrowing has declined sequentially by about 19 crores and therefore our net debt stands at 97 crores as at June 2024. We do not have any debt repayment till Q3 FY25 and we believe indemnity payments due by November 24 are largely likely to take care of repayments in FY25. With this, we can now open the floor to questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from Ran of Puneet from HSBC. Please go ahead.
Thank you so much and congrats on turning around. My first question is if you can give some color on how different are the margins from your international business and domestic business based on the new orders that you are booking.
So whatever as we have explained in our previous calls, that in domestic market margins remains from 10 to 11%. And now we are replicating the same margins for international markets where the margins remains 10 to 12%. So margin, we are very, very careful about the margin profiles and we are maintaining the same margin profile in both the markets.
Okay, and there was earlier a thought that you would do only the BOS part in the Indian market and not do modules. Does that still remain?
No, we are aware that's primarily because Indian market continues to be a BOS market. But wherever we have taken a couple of projects in domestic market with modules, but we are taking extreme cautions with Indian projects. We are choosing only Indian module manufacturers where we have the long-standing relationships and they never renege on their contracts. We have taken due care in taking the bank guarantees and used our relationships to place the orders for modules for the domestic markets. So both the orders we have picked up, we have placed the orders on reputed Indian manufacturers and there is no risk. So we will choose the projects very carefully wherever we have to place the orders with the modules included. As far as the international projects are concerned, we are very, very choosy and passing on the risk to our customers. And we are also taking precautions as we have explained in our past calls that we are taking very higher amount of bank guarantees to the tune of 15% from the module manufacturers and we are choosing a make of 3 manufacturers minimum for every project. So there is no execution or price risk remains on the project.
Okay, and you're still saying that despite taking the module linked orders for international businesses, you will still have a 10 to 12% margin. On India without the modules, you will have 10 to 12% gross margin.
That's absolutely correct. The margin profile of the projects will not change. Just that the value of the project per megawatt will change wherever the modules are included. The values per megawatt will be much higher as compared to the BOS projects.
Understood. And secondly, if you can comment on how big is the RIL's pilot project and what are you hearing from them in terms of?
So it is like, I would like to say it's a reasonable size project with a good value. and we expect to complete this project within this fiscal year. And we are using multiple technologies. So this project is very, very important with respect to testing of multiple technologies, and this would become very handy in the rollout of the larger projects with RIL.
And this is already a part of your order book?
Yeah, this is already part of our order book.
So the 1,000 crore order during the quarter would include this, or was it already a part earlier?
It's part of that particular order book.
Understood. And lastly, on the overhead side, assuming current business levels, have you reached a stable state of overheads, or is there further room for overheads to go down?
As I just mentioned, we believe we have completed most of the optimization of our overheads, and except for small increments, etc., we believe that they are now more or less stable.
Understood. That's very helpful. Thank you so much, and all the best.
Thank you. Next question is from the line of Shivani from Monarch Network Capital. Please go ahead.
Hi. Thank you for giving me the opportunity, and congratulations on good results. My question is on the order book mix. So the domestic order inflow, can you give the split of other than Serentica from whom the order has come in? And also for the international order, is Europe order with Plenitude is executed? Or if not, then how long will it take to be executed?
See, order with the Plenitude was received in December last year, and project has 18 months of timeline. So project execution has started. We are well on track. We are finalizing. The engineering has been completed and orders have been placed, and we have started execution on the project. And we are very confident of completing the project ahead of the timelines. So that is the status with the Plenitude project. As far as our order book is, Indian order book is concerned, it includes Serentica, it includes Reliance, it includes Ampere. So these are the projects included in our domestic pipeline. And as far as the international project booking in this quarter is concerned, there are two projects from South Africa, one from EMEA Group, and another is from the Energy Group.
Okay, sure. And my next question is on the arbitration process that's going on for the international order. What's the status on that?
So there are a few arbitrations which we are having in USA. So we are proceeding ahead with the arbitrations, and as and when there is a significant development there, we will inform the markets suitably at that point of time.
Sure. Thank you. I'll be in the queue for any follow-on questions.
Thank you. Next question is from the line of Harsh from Avian Capital. Please go ahead.
Yeah. Hi, good morning. Thanks for the opportunity. So I just have two questions. Firstly, on the opportunity on the Reliance project that we've done, what is the future outlook and the opportunity size of that segment? And secondly, we've seen a very significant margin jump in our O&M portfolio. So is it as a one-off, or how is that placed? Just two questions from me. Thank you.
So first of all, with respect to Reliance, to start with, it's a pilot project, as we have stated, and teams are continuously engaged with Reliance on rollout of mega projects in various regions in the country. As you know, the plans are in public domain, and it's moving faster. Teams are engaged at much broader level, and we have specially created a particular SBU for Reliance. So we are hopeful that the mega project rollout will start soon, and teams are fully involved into the discussions, and we will be at the forefront of the execution. And Bahadur will take answer on O&M margins.
Yeah, as I have mentioned in my speech, there is a one-off income of 3 crores due to backdated revenue receipts and provision reversals. Were that not to be included, the O&M margins would be close to 24%, which is close now to our steady-state O&M margins.
Thank you. And just lastly, a bookkeeping question. You mentioned the South African project. What was the size of the project? Mixed back.
One is 140 megawatt, and another one, second one is 80 megawatt project.
140 and 80 megawatt. Thanks a lot.
Yeah.
That's all from me. Thank you.
Thank you. Next question is from the line of Rohit from Aditya Birla Sun Life. Please go ahead.
Thank you for this opportunity. So my first question is more to do with the credit limits, non-fund-based limits and fund-based limits. What is the negotiation with the bankers? Where are we at this point in time? Are they like unfrozen?
So a few of them are unfrozen with, the rating upgrade which happened from D to BB+. Post these results, we will be pushing for a higher upgrade into the investment grade, which gives us the confidence for unfreezing of the rest of the limits.
Among the non-fund-based limits, what is the current level and how much is it utilized at this point in time?
The total non-fund limits are between 5,500 to 6,000 crores and roughly 3,800 to 4,000 crores stand utilized.
Thank you. That's it from my side.
Thank you. Next question is from line of Kunal Shah from RAM Capital Advisors. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, you are. Thank you.
Yeah. So, sir, one is on this revenue guidance for FY25. I think we are holding on to the 8,000 crore mark, right? 8,000 plus. Now, just could you guide, how it would be phased over the next 3 quarters? So, would one assume that, the second half would do something like a 6,000 crore sort of a revenue?
You are right that revenue execution pace will pick up from Q2. We remain very, very confident about the revenue guidance we have given. As you know, Q1 is always muted in the EPC industries, and there is no surprise in that. So revenue pace will pick up significantly from Q2 onwards, and the second half will be very, very strong, with the Q4 being the strongest.
Understood. So, but, in terms of sort of factoring in this, would there be an assumption of a rating upgrade that you're expecting now? Because let's say if there's some delay, could there be a spillover? I'm just trying to understand, could there be a delay in terms of the execution of the order backlog just because of the liquidity conditions?
So we are trying to take various other steps. While the effort is obviously on for a further rating upgrade, as I have just mentioned, we are also looking at other contingencies to make sure business does not suffer.
Okay, understood. And in terms of just from an order backlog execution timelines, could you guide if you are sort of is everything on track, or could there be some delay in terms of commissioning of those projects? Because
we don't see any. Yeah. Yeah. So you are right. We don't foresee any delay in execution of any project. We are delivering projects ahead of time, and we are always meeting our customer expectations. So we are very, very confident, and all the projects will be delivered as per the contractual schedules. We don't foresee any delay in any of our projects.
Understood. Thanks. And one last bit on this Nigeria project. So now, with the US elections around the corner, so now, any guidance on that particular project and whether it can be delayed post elections now? Because, the same might be perceived as a bit risky because on the order finalization, especially because of a potential regime change. So, there becomes a lot of ifs and buts over there. So could you just guide on this particular one?
Yeah, I will guide on that. First of all, post our last call, contract terms and conditions have been finalized, and we are in the last leg of approval. So that is happening, and which is very, very positive. And there are multiple positive developments which has taken place, and we cannot share everything on this call. So, but project is moving on right track, and we expect it to close very soon. Secondly, with respect to the regime change, there is no impact on the project financial closure with respect to the regime change in USA. The Exim Bank board remains in place. The Exim Bank of USA has already, this project exists in their list, and it's an approved project. So there is practically no risk at all. We don't see with respect to the regime change in the project, and we don't see any uncertainty on that part on this particular project. And we remain very, very confident to close the Nigeria project very soon.
Understood. Thanks. This is helpful. I'll join back with you. Thanks and all the best.
Yeah.
Thank you. Next question is from the line of Amish Kanani from JM Financial Capital. Please go ahead.
Yeah, hi, sir. Sir, can you give us some sense of, what is the average execution timeline of our order book Because now, with international order, maybe there are some longer order. As we understand, some project we have 6 to 9 months, whereas some project might have a 18-month project timeline. So if you can give us some, range of execution or, break up your order book, which is, say, more than 1 year and less than 1 year, that will be helpful within domestic and international, sir.
Yeah. So let me start with domestic. The larger PSU project, which are in excess of 1 gigawatt, has a typical execution timeline of 18 months. And the IPP projects in India, typically over 200 megawatts, have a timeline of 10 to 14 months. So this depends upon the execution targets given by the client. It can vary from 10 to 14 months. PSU projects remain from 15 to 18 months. That's the typical range. International projects also remain within the 15 to 18 months completion target. So none of our projects exceed the completion time of 18 months up to 1.5 gigawatt. And the minimum timeline for execution of project is 6 to 8 months for the smaller size projects. So this is the typical timelines on which we operate, and this is the typical cycle for revenue conversion as well.
Okay.
But it all depends upon the size of the project and the completion targets given by the client.
Sure, sir. So in that context, sir, is it possible our current order book as of, first quarter end, how much is more than 1 year and how much is less than 1 year? Is it possible? Or average? Can we take your average execution timeline right now as 15 months, sir, to simplify the thing?
Average execution timelines you can take between 12 to 15 months.
Between 12 to 15 months. Okay, and both domestic and international flavor is similar, or international will be slightly longer than domestic?
International is slightly longer.
Okay, that helps, sir. Thanks a lot, sir, and all the best, sir.
Thank you. Next question is from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Hi, thank you so much for taking my question. I would like to ask you about the macro scenario of the world. So as the US has imposed the ULSA regulations, do you see any other countries, especially say in the EMEA region, trying to do something like that, number one? Number two, as of now, we know that these restrictions are purely on modules. Do you think that these restrictions could come in on cells, and would they then affect your projects outside of India?
No, actually, right now we are not executing any project in USA. So any particular regulatory impact in US markets don't impact us. So we don't see, like, we are operating in Europe, and we are operating in right now, as per the international projects, are South Africa. So both the projects are in Europe without modules. So whether any impact on cell or modules, that doesn't impact us. Our business is totally risk-free with respect to the modules here. In both the South Africa projects, we don't see that happening because that market doesn't have any domestic production at all. So in both the projects, we are allowed to import modules from China. So as far as our international market is concerned, we don't see any impact of these regulations on our business and projects which are with us. And in any case, the custom duties and statutory risks are always passed through. We negotiate that very carefully in our contracts so that they never impact us. So that is duly taken care of in any eventuality if a risk arises. So we are completely safe from all those exigencies.
All right. Thank you so much.
Thank you. Next question is from the line of Jay Shah from OHM BMS. Please go ahead.
Hi. My question is, you're looking at...
Jay, sorry to interrupt you. Can you speak through your handset, please?
Is it audible?
Hello, Jay.
Yes, still little feeble, but if you can be a bit louder.
Hello. Is it better?
Jay, can you speak through your handset because it's not clear?
Hello. Is it better?
Yes, thank you.
Yeah. My question is, you're looking at executing 6,000 crores in second half. You have a bank guarantee or non-funded limits of also 6,000 crores. So is that enough? And even right now, when you've utilized 3 to 3,500 crores, last year your turnover is around that much. So is there a one-to-one correlation between your non-funded limit utilization and sales?
It's not necessary because generally when you have a project, you will have a 10% advance and a 10% performance bank guarantee. your advance bank guarantee tends to fall off within a year. As far as your letters of credit are concerned, they are for significant equipments like trackers, steel, inverters, IDTs, etc., cables.